Good morning, ladies and gentlemen. Please be seated. Welcome to the Real Leasing Conference. My name is Ken Norris, and I am a Managing Director at Colliers International in Toronto. It's my great pleasure this morning to introduce to the Real Leasing Conference attendees our featured speaker, Dr. Sherry Cooper, Executive Vice President and Chief Economist at BMO Financial Group. Dr. Cooper is a constant demand for a speaker with her ability to simplify and demystify the complex subjects of economics and finance. In 2010, Dr. Cooper received the Lawrence Klein Award for U.S. forecasting accuracy, beating a panel of 50 economists at predicting the four-year period from 2006 to 2009. A very impressive win in tumultuous times. Dr. Cooper has an MA and PhD in economics from the University of Pittsburgh and leads a highly respected team of economists at BMO. Dr. Cooper has been repeatedly cited as one of the most influential women in Canada. Regularly quoted in the financial press, most of you have heard or seen Dr. Cooper on radio, TV, and most recently at Colliers Breakfast. Please join me in welcoming Dr. Sherry Cooper.
Thank you so much. Good morning, ladies and gentlemen. This is a great audience to be speaking to because real estate is at the top of my mind these days. I'm one of those empty nesters that has a home on the market and a condominium that's already partly paid for, and believe me, I am nervous. Not nervous so much because of anything to do with Toronto or anything to do with the strength of the Canadian household, but nervous because the backdrop of the global economy and financial markets is at this moment certainly unnerving. This is a time when the world is still responding to the financial crisis of 2008 and the balance sheet recession that continues in the United States and other parts of the world. You see, a balance sheet recession is very different than the typical business cycle recession we've all experienced. In a balance sheet recession, what has happened is that the value of assets has plummeted. In this case, the housing market in the United States. The housing market, of course, is the most important component of household net worth. And so homeowners and households in general in the United States have experienced a devastating hit to their net worth. And as you know, roughly 20% of homeowners are now upside down on their mortgages, so they cannot refinance at today's record low interest rates. In addition, the foreclosure pipeline continues to be enormous. Between 2 and 4 million homes will be foreclosed and vacant, leaving the inventory of unsold homes in the U.S. at even higher levels. So this is not the kind of recession that one recovers from easily. It does not respond to easy monetary policy. And in fact, there is a negative feedback loop because businesses who are experiencing reduced order books, of course, are reticent to hire. And as hiring remains weak, households suffer job losses and very low levels of confidence, and therefore they're deer in the headlights when it comes to any financial spending decisions. Now, I tell you about this here in Canada because inevitably we are impacted not just by the net export decline to the United States, but also the psychological impact of this on Canadians. Canadians watch American media. Canadians, of course, understand the fear that's going on in the U.S. But what's different now is that, in my view, the number one risk to the economic outlook comes from overseas in the European credit crisis. The sovereign debt crisis is at a critical level right now, and the only response that Europeans and even our own Prime Minister, as well as David Cameron in the UK, suggest is further fiscal tightening. They did that early in the Depression. Herbert Hoover experiencing a rise in the budget deficit from surplus to deficit because of the contraction in economic activity dramatically increased taxes. At the same time, the leader in Germany did the same thing. And of course, you know that it wasn't until the Roosevelt era and the New Deal that counter-cyclical fiscal policy came to its fore. Now, I know that debt is a bad thing, and I realize that profligate countries like Greece ended up getting themselves into enormous difficulty. But you see, counter-cyclical policy is meant to go both ways. In good times, we're to have fiscal surpluses, just as we did in Canada, so that in bad times, the government does have the leeway to help to hire workers in infrastructure programs, to spur economic activity, and to improve the lot of household net income. Now, this shows you the economy in Canada and the US. Canada has been a bastion of stability. Even during the recession, our recession was much milder and much shorter than in the US. And as well, the rebound in the United States is woefully disappointing. Everyone has been reducing their estimates for the economy, and now we're all pretty much in the same boat, saying that we're likely to see real GDP growth this year and next year in the US at less than 2%, which means that the unemployment rate will not decline. And in Canada, though our domestic economy is much stronger and our households are in relatively good shape, unfortunately, our net trade has moved from a record surplus to a record deficit, thanks to our number one trading partner. We've made up some of that with trade to Asia. I was in Vancouver and Victoria last week, and BC has certainly benefited from the export of forest products and coal and other products to Japan and to China. But still, that's not enough to make up the difference in the US. By every measure, the Canadian economy has outperformed economies everywhere. But nowhere has it been more vivid and more important than in the labor markets and in the residential and commercial real estate markets. Looking at the US data, you see that there are still roughly 7 million jobs below the peak levels prior to the beginning of the recession. And not only that, but there are 14 million unemployed people, and existing homes, new homes, all housing construction activity in the US is at its lowest level since 1950, when the population was a third the size. This is, of course, without precedent since the Great Depression. I'd prefer to call what we're going through now in the US the Great Contraction. And it is the first great contraction since the Great Depression. Businesses, fortunately, aside from those in construction and real estate related, have actually done remarkably well. Unlike the Japan collapse, where there was a balance sheet crisis for both households and businesses, In the United States, at least the business sector is relatively strong because businesses responded very quickly by cutting their payrolls dramatically, improving productivity. Business cash levels are at record highs in both Canada and the US, and earnings have been strong, although earnings growth is certainly now slowing. Businesses in the US and Canada have invested in technology and R&D, and it has paid off. But what will it take for businesses now to hire workers? Well, certainly what it takes is improving confidence and a rise in their order books, which is very tough to see when consumers are worrying about their jobs. This shows you, in the United States, the official unemployment rate is 9.1%. Our official unemployment rate is 7.3%. But in Canada, when they do the labor surveys, you're considered unemployed if you say you are. In the United States, you have to prove you're unemployed by having had a job interview in the previous 4 weeks. Well, as I'm sure many of you know, there are people in the US who have been unemployed for a very long time, who have sent out hundreds of resumes with little response, and they can't get job interviews. When you look at the measure of unemployment that would be more similar to that of Canada, the jobless rate in the United States is 16.2%. During the Great Depression, the jobless rate ranged from 15% to 25%. But remember, back then, most women were not in the labor force, or at least not to the degree that we see today. The unemployment rate is also not just the only measure of the pain, but the average duration of unemployment is at a record high. It averages more than 10 months, which means many people have been unemployed for years. And the value of your human capital deteriorates. It makes it much, much more difficult to find a job if you've been out of work a long time. And of course, those small business owners that were forced to shut down because of the drop in real estate or the reduction in retail sales, many of them are unemployed for the first times in their lives. These are good paying jobs that have been lost. The financial services industry in the US is contracting dramatically. At the state and local government levels, teachers and first responders and public sector workers have been laid off. We see contraction in everything to do with real estate and retail sales, not to mention Wall Street. So people who will become employed again will often make far, far less than they did prior to the layoff. And combine that, of course, with the fact that household net worth has plummeted, you can see why consumer confidence in the US is extremely low. In Canada, consumer confidence has remained higher, but even here, in recent weeks and months, that level of confidence has edged downward. Look at what's happened to wealth destruction. That first chart is net worth as a percent of income, and it has plummeted, despite the fact that income levels have fallen. For Canadians, however, net worth ratios are near record highs. And of course, it's reflective of the plunge of the value of home equity in the United States. And in response, Americans are tightening their belts, and personal savings rates out of income have increased sharply. Here again, you see the relative difference between Canada and the US. Personal consumption in Canada is stronger than it was in the beginning prior to the recession, and in the US, it's barely caught up. Personal income growth in Canada now exceeds the level prior to 2008. In the US, real incomes still are falling. The debt levels of Americans have declined. Some of it was voluntary and some of it involuntary because of foreclosures and bankruptcies. Governor Carney is concerned that for Canadians, the household debt to income is at a record high level. The fact is, though, it makes sense given that mortgage rates have declined so substantially. I do, however, agree with him that roughly 6 to 10% of households may well be overextended in this country, paying about 40% or more of their disposable income into housing-related expenditures. With any luck at all, however, interest rates will remain low, and Canadians are not confronted with the prospects of massive layoffs. Where in Canada, the credit growth has diminished, in the United States, credit is actually contracting. And banks have excess reserves. The Federal Reserve has been very aggressive in easing monetary policy. In the last 13 weeks, the growth of the money supply has been more than 25%. And banks hold excess reserves because there are insufficient numbers of qualified borrowers, according to the banks, and you need to have an absolutely stellar credit score and rock-solid jobs in order to get a loan or a small business loan in any event. New home sales in the U.S. have plummeted. Existing home prices continue to fall. In Canada, we've seen a slowdown in the growth of existing home prices, but those prices are still rising. The ray of hope is that housing starts in the United States are at their lowest level in my lifetime. Housing starts are dramatically below the level of household formations, unlike in Canada, where they're running pretty much neck and neck. The U.S. also has the advantage of enormous population growth compared to the rest of the developed world. Boomer kids now are of an age where they are in the housing market for the first time. And this, of course, is the winner in this situation will be the first-time home buyer that does have a good enough job and a big enough down payment to be able to buy a home. Unlike countries like Japan and Germany, in Canada, we do still see population growth, and for the U.S. and Canada, that important age group, 20 to 34, people who are getting their first jobs, forming households, having families, continues to grow. So ultimately, we will see the inventory of unsold homes work its way down in the U.S. But again, this is a balance sheet recession that takes a very long time to correct. Looking at house prices around the country, Vancouver continues to defy gravity. But I can tell you that with an average home price now of $779,000, that compares to $830,600 last March. So in 6 months, median house prices in Vancouver have declined, some of it in response to the tightening requirements for CMHC. And we have seen a slowdown in the rise in prices. It had been 21% year over year. Toronto, in my view, is less vulnerable to the bubble or the overheating than Vancouver. In Toronto as well, though, much of the building and much of the higher end buying in the condo world, in the hotel condo world, and certainly at the high end of the housing world is from foreign money. Some of it are residents of the city, and much of it is simply a diversification of their portfolios. The Canadian dollar is seen as a strong currency. Toronto and Canada in general, a safe haven. Where Vancouver is a starting off point, a jump off point for Asia, Toronto is a jump off point for New York and Chicago and the rest of the United States. And I'm optimistic that that will continue. But nevertheless, if we continue to see the crisis mentality emerge, even activity here will slow. Now, on the positive side, American retailers, having saturated the market in the U.S. with a retail spending bubble that has burst, they're moving to Canada. That's great news for Canadian consumers. It means we will finally have enormous competition and variety, the likes of which we've never seen. In addition, it's great for shopping center real estate. There's a shortage of it, and prices will be rising. Of course, the bad news will be for Canadian retailers, and they absolutely have to step up their game. The retailers in Canada, in fact, have been lazy because Canadian consumers have just not been as demanding as American consumers. When I first moved to this country, I was astonished when I went into Holt Renfrew and told them that I'd like to see a pair of shoes in a size 6. And the lady came back with a size 7 and a size 5 and couldn't understand why I wasn't interested. You see, that's a Soviet mentality. You know, you can have any color shirt you want as long as it's blue. Americans don't put up with that. In addition, Canadian retailers have not developed their online capabilities sufficiently. And more American online retailers are now shipping to Canada and taking Canadian credit cards. And you better believe that the ones that open up here will be extremely aggressive in doing so. Zappos Canada shut down their website because they said they could not provide the service that their customers expect, thanks to all the difficulties with duties and restrictions at the border. We saw what happened with J.Crew as Canadians finally are balking about having to pay inflated prices. This will change. It will mean that inflation pressures will be very muted. But for the Canadian Tires and Loblaws of this world, they'd better get their act together. In addition, on the office side, we've seen vacancies decline, even in Calgary, where the overbuilding was huge. It's really interesting. None of us, at least I can't remember, an office building boom in downtown Toronto, the likes of which we've seen, and yet those spaces are filling up, and more product is coming online, although not as much as we've seen in the recent past. And I can tell you, because I work in First Canadian Place, that even the older buildings are in the midst of trying to renovate to keep up with that new competition. This is a sign of tremendous vitality. And of course, it does help as well to augment the residential side of the building boom. Construction growth, though, is slowing. The government infrastructure projects are pretty much completing, and business activity, though still strong, is slowing a bit from what we saw last year. When we look around the world, the G7 is having difficulty. The strongest economy right now is Germany. Germany is the single largest beneficiary of the European Union, because instead of an extraordinarily strong Deutschmark, Germany has a euro that is much weaker than their domestic economy would warrant. And Germany is therefore an export powerhouse, exporting to Asia, the United States, Canada, but also exporting within the European Union. Germany does not want to see Greece exit the Union and certainly does not want to see the end of the euro. As we move further along, though, of course, we've seen the emerging world as the growth leaders of the global economy, representing 3/4 of all the growth in the global economy in the last 5 years. But even there, the activity is slowing. Activity is slowing in China, in India, in Latin America, in Brazil in particular, and the list goes on. As well, the European banks have been enormous, the single largest lenders to China, and the European banks are in trouble. So you can see that the interconnections of what's going on in Europe has tremendous impact everywhere. In addition, thanks to the slowing global economy, commodity prices have fallen sharply. Even gold prices were down sharply last week. But oil prices, natural gas prices, zinc, copper, they're all down. And that's one of the reasons, the most important reason, why the Canadian dollar has fallen below parity. As well, the US dollar benefits from what is this tremendous uncertainty, risk, and fear associated with the European crisis. The euro has been trending downward. The Chinese currency has appreciated, but it's still very much undervalued. Canada is in competition with China for imports to the United States, or their exports into the U.S. So Canada, you see, has to diversify its trading partners. In many ways, we are all in this mess together. Now, in this environment, inflation is the last thing to worry about. If anything, I'm more concerned about the deflationary psychology in the U.S., where first-time home buyers don't feel any urgency to make purchases because they feel that house prices will only fall further. What has happened is the emerging world has suffered the inflation, and so the central authorities there have tightened monetary and fiscal policy. And as a result, those economies are slowing. Our own Bank of Canada, Mark Carney, in a speech last week, did say that he is no longer concerned about near-term inflation pressure in Canada, but he's more concerned about the negative knockoff effects of what's happening in the rest of the world. So he will refrain from raising interest rates for the foreseeable future. In the United States, they've gone even further. In my view, the Fed and Bernanke have run out of bullets. They're shooting blanks. You see, Bernanke told us that he's not going to raise overnight rates for 2 years. That's supposed to reduce long-term interest rates, and it did. Then he told us last week that they would engage in what people are calling Operation Twist. They would adjust their bond portfolio, selling short-term bonds to buy long-term bonds to lower long-term interest rates even further. So right now, the 10-year yield in the United States is 1.89%. 10-year yield. And that's on government bonds that were downgraded by S&P. In addition, if you were to invest in a 2-year bond in the U.S., you would get roughly 17 basis points. On 3-month and 1-month bills, you would get 0. In fact, earlier in the recession, you had to pay the U.S. government for the safekeeping of your money. The 30-year fixed mortgage rate in the U.S. now averages 4.09, but these are weekly numbers. When we get the next number, it will be substantially lower. This, by the way, is an extraordinarily wide spread between long-term U.S. rates and government yields and mortgage rates. That, of course, is because of the risk inherent in these mortgages. But the hope is, by the Fed, that they could get mortgage rates down to 3%. But the day he announced this plan, the stock market sold off dramatically because no one believes that interest rates are the problem. And liquidity isn't the problem. The problem is the debt overhang for American households. And the only way to deal with that is to use precious government money to restructure this debt, to, in fact, help households be able to afford homes. When you look around the world, the debt to GDP ratios at the government level in every country has increased. The dark bar here is 2008, and the lighter bars are 2011. This is no different than what happens in any recession. In 2008, literally 3 years ago, in late September 2008, right after the Lehman bankruptcy, there was an emergency meeting of the G20, and things were bad enough that every single one of them agreed to do two things. One, bail out the institutions that would cause systemic risk, and two, stimulate their domestic economies. Everyone complied, and therefore, when you stimulate, when the economy is contracting, of course your debt to GDP ratio rises. For a country like the United States, there is zero probability that the U.S. would default on its debt. The U.S. has enormous capability to meet its interest requirements and its maturing debt. In fact, as we've seen, the interest rates of this debt have done nothing but plunge ever since. In other words, the price of the bonds continue to rise. To be sure, it is a good thing for Canada or Germany or the United States to have a longer-term plan to eliminate these deficits when the economy rebounds. The best way for the U.S., and most effective, sustainable way for the U.S. to eliminate its deficit is to put people back to work. And then they can also reform their tax system, eliminate loopholes, possibly introduce a value-added tax. They're the only country in the OECD that doesn't have one, and address the excesses in Medicare and Social Security. But you don't do that at a time when your unemployment rate is where it is today. We also see that even individual countries can't get it together to do what's necessary. So how would we expect the 17 countries of the European Union to do it as well? And that's, of course, the problem. The bottom line is stock markets have fallen year to date. Now, I know we've had a couple days now, at least yesterday and early so far, overnight today, the markets are up. But look at the dividend yield on the TSX. It is 2.8%. When bond yields, 10-year government bond yields, are below 2%. That is unprecedented. In addition, we have seen such a decline in many valued companies that individual dividend rates are really high. This shows you the collapse in the S&P and TSX from the period right after the crisis began into March 9th, the spring of 2009. The recovery was huge, but more recently, since July, there's been a big sell-off, but nothing compared to the sell-off in the German stock market, the DAX, which, by the way, is the strongest stock market in Europe. If I showed you the Greek stock market, you wouldn't believe it. Everywhere in the world, banks have been tarred by the same brush. Canadian bank stocks have fallen, but not nearly as much as in the United States and Europe. But Canadian bank stocks have fallen so much that Canadian banks' dividend yields are between 4 and 5%. Now, in my view, that makes no sense, particularly given that Canadian banks haven't cut their dividends since 1930. And not only that, but Canadian banks have Tier 1 capital levels in excess of any other banking system in the world and very little direct exposure to Europe. But there's no question that if we see Europe going into recession, and Europe is on the brink of recession, that could spill into North America. And then, of course, banks everywhere have the impact of delinquent loans and problem loans. And the flattening of the yield curve by the Fed, of course, makes it more difficult for the American banks to make money. And another unintended consequence is the pension funds, which many of them are already underfunded, become even more underfunded if the yields on their bonds fall. So, bottom line, the list of challenges goes on and on and on, and we know that most of the risk is on the downside. But the opportunities are also immense, and especially in Canada, and especially in the major cities of Canada. Toronto is the financial hub of this country, and it is going to be increasingly a global financial hub. Our banks are strong, our regulators are strong, and our political situation is stable. We are able to trade around the world. We need to build the East-West pipeline from Fort McMurray to the deep sea ports of Vancouver so we can export oil to China. We can no longer depend on just the United States for our oil exports. We are already exporting many of our minerals and base metals and forest products to China and the rest of Asia. And Latin America also will be a huge growth opportunity, as well as even parts of Africa. Foreign capital flows into our country have been strong and will continue to be strong. In my view, the biggest challenges are in improving productivity and research and development within the private sector. RIM is a great example of that. I don't want to dump on RIM. I think RIM has really been a spectacular company, but RIM dropped the ball in the iPad. You can't have a Me Too strategy any longer. You have to be at the leading edge of technology. And Canadian companies everywhere need to have the seed capital, the venture capital that is also required in order to develop the best and the brightest. We are at the leading edge in many, many of the growth areas. You know that Canada is the video game capital of the world. Vancouver, Toronto, and Montreal have taken the lead in the development of games online. That may sound like a minor thing, but it is a huge and rapidly growing business. So if we can get our public companies, the universities, for example, the hospitals, to work with the private sector to commercialize all the development that does occur in this country, and continue to follow reasonable countercyclical policies, I believe that Toronto and Canada in general will continue to be a global growth leader. Thank you.
Thank you, Dr. Cooper. An always very informative and insightful presentation. And we hope you join us next year because we really enjoyed that. So thank you very much. And good to see some glimmers of hope for Canada. Next, I'd like to introduce our next speakers from Colliers International. Although they're not as attractive or have the academic pedigree as Dr. Cooper, they promise to provide us with an engaging presentation. John Arnley is Managing Director of Toronto and my partner with 26 years of experience in the brokerage business. And joining him directly to my right is our Executive Vice President and illustrious leader, Scott Addison.
Thank you, Ken, for the warm and accurate opening for John and I. So we've had an interesting 4 years, having gone through, since 2007, having gone through a significant worldwide recession and a recovery and some challenging times ahead from what we've heard this morning from Dr. Cooper. Today we're not going to talk to you about all the typical information you get in a market overview. We wanted to look at information from a different perspective and make it interesting for you. And also, if you were lucky enough to be here last year, we wanted to stay with the interactive format that we had. So each table has several polling devices on them. They have multiple choices. We're going to be dealing with A to E today. The first 5 choices, for those of you who can count. If you could all take a moment, grab one of these, and just turn them on. The bottom corner, the bottom right-hand corner, there's a button. Just turn that on, and it should read vote when you do that. Everybody ready? So between John and I, we're going to go through several questions today. After we ask the question, you're going to have 15 seconds to provide your answer from A to E, and then we'll compare your answers to actual statistics and information. So today we're going to cover the GTA office market, industrial, investment, and retail, and compare it in a North American context. We'll provide you with some interesting insights into the market and leave you with some surprising takeaways.
Okay, let's get right into it and try to put the GTA office market into a North American context. So, first question simply is, where does the GTA rank in North America based on total size of office inventory? Oh. Well, the correct answer is D, 8th. So we slipped one by you early here.
So some surprising takeaways.
Yeah. So, probably not surprising to anybody, New York City is the largest at 520 million square feet. Washington, D.C. with the huge government sector second at 450 million. Surprising to me was that Dallas and Atlanta slipped in ahead of Chicago and Los Angeles, traditional office powerhouses in the U.S., and the GTA comes in 8th at 180 million square feet. For those who are curious, Boston was 9th at 165 million square feet. So, let's keep on the same theme of office inventories in North America. And now we'd like to know your opinion on the fastest growing office markets. So to put this in context, what we're looking for is the percentage growth from 2007 to the present. So the question simply is, where does the GTA rank on percentage growth of total inventory in North America? Oh, very good. Second is correct, and B. You're getting sharper, very good. Okay, so the GTA ranked behind Houston, which was first. GTA had 3.7% of total inventory growth. That's close to 7 million square feet. Obviously, this bodes really well for the GTA coming out of the recession. As Dr. Cooper talked about, strong banking and service sectors are really what's driving the demand here. What's interesting to note is that Houston and Dallas, being driven by the oil sector down south, leapfrog some of the larger markets in the U.S. of Washington and New York in percentage growth.
So in keeping on the theme of where the GTA ranks in North America, we're asking you to look at the size of GTA's industrial market. So the question's quite simple. Where does the GTA rank in North America on size of total industrial inventory? Well, the correct answer is C, third. Congratulations, we are definitely getting better. So Chicago's the largest at 1.3 billion square feet, followed by LA at 880 million square feet, Toronto 760 million, third, and we're just ahead of Dallas and New Jersey. I think quite interesting, rounding out the top 10 is Montreal at 335 million square feet, just behind Cleveland with 420 million square feet. So Montreal just gets in there. So we know we rank third in North America in square footage, but where do we rank in the same set of cities in percentage growth of the industrial market since 2007 to the present day? Well, the correct answer is C. Both Dallas and Houston lead the list when looking at percentage growth. Dallas was about 4.2%. The GTA was close behind in third place with just under 3% growth since 2007 to 2011. But that's 21 million square feet we've added, which surprised me. Also surprising, Montreal grew during that same time period at 3.5 million square feet. So I've stated that our industrial inventory grew by 21 million square feet, and in order to support that growth, we needed land to do it. So what's been happening with land in the market during the same period of time? And typically, during a recession, the volume and values of land drop pretty dramatically. It's the most volatile of all asset classes. So to provide you with some assistance for the next question, we've analyzed the volume of industrial land sales, and I can tell you that at the peak of the market, we were selling about $440 million annually. That dropped to $104 million at the bottom of the market. So the question is, with a significant drop in land activity, what was the percentage change in industrial land prices from 2007 to the present day? Well, 58%, that's excellent. Because the correct answer is B, no change. So currently we're seeing land prices sell at least pre-recessionary prices, and many in Colliers believe that we'll hit new highs to the end of this year and into 2012. This is due because the land market is restricted by greenbelt, water to the south, zoning, official plan regulations, servicing concerns, and the fact that large portions of land are held by a relatively small group of well-financed developers and investors. So that brings tremendous stability to our market. If you look at a comparable land market as Chicago, they're still 20% down on their pre-recession prices. So from land prices, that now takes us to industrial asking rents. The next question is, which city in North America has the highest industrial asking lease rates per square foot on average? Well, the correct answer is C. Industrial must be a lot easier, I suspect. So the correct answer is C, Fort McMurray. It just happens Colliers has a listing in Fort McMurray that I thought I might feature today. This is a pretty typical industrial building. They're asking $40 per square foot per annum for their lease rate. That's based on $3 million per acre for land. That's typically what it's trading on. This is largely being driven by the oil sands. So when we all in Toronto start driving our Volts, look out in Fort McMurray. But what might be more relevant to the people in Toronto is, where does the GTA rank? Well, the GTA comes in at an average asking rates now about $5.25 per square foot, which ranks as 28th in North America, just around Baltimore and San Jose. John, it looks like we should have been buying buildings and land in Fort McMurray in the last 10 years.
What a fabulous segue, Scott, because I'm going to now shift to investment, particular GTA investment. So, simple question, what was the percentage decrease in investment dollar volume from the peak in 2007 to the trough in 2009? How do we do? Ooh. Okay, well, obviously industrial is easy because we didn't get that one right. The answer is E, 56%. That's a fairly dramatic drop, and you can ask any of the investment brokers in the room and they'll attest to that it was a pretty dry time. But to put that in context, 56%. In the US, the drop was 86%. So again, we fared fairly well. Once again, the resilience of the GTA shows through. We're seeing a bit of a rebound in the US and a rebound in Canada and GTA especially, so that's positive as we move forward. Okay, so let's try to bring retail into the conversation here. And specifically, we're going to talk about retail spending. Retail spending is a great indicator of consumer confidence. Consumer confidence is a great indicator of overall economic health, which is a great indicator of the health of the commercial real estate market. So, simple question again. Where does the GTA rank, this time in Canadian cities, in terms of retail spending per capita? Industrial really is easy. You guys threw up a donut on this one as well. The answer is E, 7th. GTA's in a dead heat with Vancouver at 7th. Probably not surprising, maybe is surprising, that Calgary and Edmonton are 1 and 2 based on the oil boom. Halifax is number 3, that's surprising to me, followed by Ottawa and Montreal. So there could be a bunch of reasons for this. The one that makes the most sense to us is the cultural diversity and economic disparity in the two large cities of Vancouver and Toronto. Obviously, the spending habits in these two cities are going to vary widely between all the residents. Another explanation might be average income per capita. That would explain Calgary and Edmonton. Doesn't explain Halifax to me. That's an anomaly. But to put it back into a North American context, Dr. Cooper touched on a little bit. Canadians spend on average about $500 more per capita than our American counterparts. Interestingly, back to the GTA, at 22 square feet of retail space per person, the GTA is very similar to Boston and Chicago. That surprised me a little bit. Okay, so let's get back to office and focus on office in the GTA. So rather than ask you about net effective rates or asking rates, because you can ask any Colliers broker in the audience or check one of the Colliers reports online, we thought a more unique metric to explore would be space per employee in the GTA office market. Okay, so to put this in context, pre-recession, the average space per office employee in the GTA was approximately 190 square feet. Question is, what is the average space per office employee today? Oh, very good, very good. The answer is E, 175. Excellent. So, a fairly significant drop from 190 to 175, considering that we went through a recession, and you'd think that less people were employed. The fact is that according to the Conference Board of Canada, white-collar employment actually grew during that period. Only a small percentage of companies expanded their footprints, but we're still increasing employment and getting more efficient, and that's what drove the number down. So, the question is, will this trend continue? Or with new office buildings being built with green technology, open concepts, the concept of hoteling, will companies in the future go back to expanding their footprints as their budgets loosen? And with that, I'm going to kick it over to you, Scott, for your final comments on industrial employment.
Well, if we take a look at the same statistics on the industrial side, we've seen a 70% increase in the square footage per employee since 2002. In the corresponding time frame, we've also seen a 33% decrease in manufacturing employment. This is within the GTA. So there's two trends going on. We've definitely lost manufacturing jobs, so there's less jobs on that industrial square footage. But there's also more space per employee as we shifted from manufacturing to distribution and warehousing. An interesting thought to leave you with is this, and many people ask me it. With land prices increasing and the lack of available service land, are clear heights going to go to a new frontier 40 or 50 feet? We haven't seen it yet, but I've been asked that quite often. And that leads you to the question, is should the measurement of industrial space be in cubic feet rather than square foot, the traditional square foot, as clear heights drive clear? So as land gets more expensive with the Greenbelt and servicing issues, it seems logical to me that we're going to go up. It's a cost-effective solution. Maybe next year, we're going to be able to provide you with answers to that. So I'd like to thank everybody for your time today. I think we got finished sooner, which I think everybody's normally happy with. You can stay in touch with Colliers through Twitter and our new website. And before you go, I have one important note that George wanted me to pass on. If you're getting RICO credits today, and a lot of you are, you must sign in at the registration before the next session begins. So on behalf of Colliers International, welcome to the 2011 Real Leasing Conference, and thank you.